jump into our next panel, Global Macro. I'm very excited to dive into this. To my left, Danielle DiMartino Booth, our Federal Reserve insider and author of Quill Intelligence. Great to have you back. Thanks so much.
Happy to be here. Hello, everybody.
Brent Johnson, founder of the infamous dollar milkshake theory, which I will argue was premiered for the first time ever at this conference. I know that's hotly debated, but I'm taking the claim. Adam Taggart, you probably recognize, was the face of Wealthion for many years. Now he's got a new show, Thoughtful Money. Adam's great to meet you.
Great to be here, Jay. Thanks for inviting me.
I'm happy that you're here. It's fine that you've never invited me on your podcast. I never even think about it, to be honest with you. And Danielle Park, Venable Park Investment Counsel. So glad you're here. What I love about Danielle's work is that I've mentioned this a few times already this morning, but in a world full of sensational hyperbole, I find that Danielle really gets down to the signal amazingly well. So thank you all for joining me today.
Thank you.
Brent, I have to start with you because your name was mentioned by every panelist at the last talk, probably 5 or 6 times. And so we were discussing the theme of de-dollarization, right? And we were talking about global trade trending away from US dollars. We were talking about countries' reserves trending away from US dollars. And it's a seductive topic, right? Because it falls into the, sort of the doom and gloom or the crisis narrative that the world's changing dramatically so. What's the other side of that argument, if you would just simplify it like that? But what's your take on the concept of de-dollarization? We'll start from there and then jump off.
Yeah, I mean, I tend to think that, well, first of all, the panelists that mentioned me, I thought they were very nice and generous. So I appreciate their comments. De-dollarization, I think, is a real thing in theory. In other words, it's definitely out there. People are definitely talking about it. Countries around the world are trying to figure out a way how to do it. I just don't think the success is there. And it's kind of the difference between desire and ability. Right? There's no question that people are trying to figure out a solution, but it's really, really hard to just say you're going to switch for all the reasons I've detailed on many presentations. The other thing I'd say is one of the things that kept coming up was that the de-dollarization would be potentially happen in the future, but what's already happening is a change in the global reserve asset. So you could keep the dollar as a global reserve currency for a long time, but people just no longer store their money in dollars. And there's some truth to that, but I think people say they're going to stop buying treasuries. Again, there may be some truth to that, but they are not going to stop buying treasuries and keep buying Italian bonds and Australian bonds and Canadian bonds and Russian bonds and Chinese bonds. So I do believe we are going to have a sovereign debt crisis, but I don't think it's going to be because everybody just sells treasuries. It would be because they're selling gilts and BTPs and French oats, and all of the sovereigns get rejected as opposed to just treasuries.
Okay, now one thing you mentioned there, it's essentially, to summarize, it's cool to have a vision, but actioning that's a whole different story. So we can talk about de-dollarization, but doing it's a whole different thing. Danielle, I saw you nodding your head when Brent was talking about that, so I'd love you to chime in.
Pop quiz, what was the last currency that Saudi Arabia issued sovereign debt in not too long ago?
About 50 billion in US dollar bonds.
Thank you.
All right. So what is the resistance? And this is really, really important because there's a parallel narrative occurring right now in our world, right? I would say on the back of the renewable energy trend. Like, everybody loves the promise of renewable energy. Who wouldn't like that? But to accomplish those goals, we have to extract a ton of ingredients from the earth that we don't presently have right now. The jump from one to the next is a lot harder than just thinking about it, right? Setting the vision's easy and fun. Doing the work's a different story. So what is the resistance, Danielle, to the de-dollarization trend?
Well, I mean, I don't think that there's resistance as much as there's just a recognition of practicability. And that really is what it comes down to. And look, people bark all the time about China's not buying as many treasuries, and I'm like, China's not selling us as much stuff. So they don't have as much to put back into treasuries. They'd prefer to have more treasuries, I will tell you that much. So this idea, I think one of the bigger events of 2024 comes in June with the election in Mexico, with the presidential election in Mexico. 6-year term, fabulous opportunity to continue moving that supply chain away from China. And it wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction, the exact opposite direction. China shrunk on a relative basis. So they're at risk of no longer being the second biggest economy in the world. And who would have thunk that? But they don't have reserve currency status, and they have grown on the back of debt, and they don't really have an outlet.
I love how you brought up the other side of the balance sheet, because yes, they're buying less treasuries, they're taking less cash in, so they're spending less money, and that's
that's the thing. People are always like, oh, the supply chain disruption caused inflation, and I'm like, well, isn't there demand? Didn't we helicopter money like $10 trillion to people, and weren't there lines around Chanel and Gucci? I mean, some of it's demand. You have to look at both sides of the equation. You cannot just isolate one. And look, this situation in the Suez, it could cause higher prices because of global shipping rates going up. But, my grocery, I was tweeting about this yesterday. My grocery store circular is it's bigger than what it was pre-COVID. There's more on sale, whereas at the peak of COVID, it was one page back and forth. So the thing is, it's going to run into a wall. You can try and raise prices as much as you want, but listen to all of these earnings calls. There's a simple thread that's running through all of them, and that's we're losing pricing power. We can no longer raise prices. That's what happens in recession.
Thank you. Danielle, I want to pass it to you. I saw you nodding your head along there, specifically about the comments regarding China. Interesting, because our Canadian economy is very tied to the Chinese economy. Our housing market, very tied to Chinese wealth, and you cover this in your letter every month. So what's your take on the health of the Chinese economy at present, and how that may impact Canadian housing, which is another thing that you cover in depth?
Yeah, and thank goodness someone brought up what Danielle just mentioned, because I was going to mention there's too much, I think, credence given to this notion of strategic allocation, when in fact much of the time it is a panicked necessity to get certain cash, for example. And if the bulk of the world's debt is in US dollars and interest rates have gone up, people need more US dollars to pay the costs of that debt. I think that's very often underestimated. So the other thing about that, of course, is you mentioned Canada. Of course, we're the poorer cousin, so to speak, of the US economy, and we're very much tied to what goes on there. Well, we have a major housing crisis reflective of the Chinese housing crisis, symbiotic, as you mentioned, and we have to keep our currency relatively weaker to get out of this mess that we're currently in. So the fact that the US has hiked rates as much as it has, and Canada has gone in lockstep, we also have a double-sided problem here. We don't want to reinvigorate housing costs, which are off the charts and crushing households. 55% of household income is going to keeping shelter over our heads in the Canadian economy. We are less productive than we were 20 years ago. We have screwed up. We used a decade of zero interest rates to pump into the least productive segments of our economy. Consumption, housing, bigger, more flashier, doesn't make it more productive as shelter. So we have really screwed up. Now, we're in good company globally. Low rates were horrible for everybody that was trying to do anything productive or intelligent with capital. So thank God Jay Powell and company hiked rates. I'm very happy that they did. I hope you're right, Danielle, that he doesn't want to go back below the 2% threshold. We shall see. But there is a liquidation necessity going on in the world today, and I think it's going to get worse in 2024. Cash is king. If you look at the balance sheets, most people have very little cash. Households have but 4% of their wealth in things like bonds or liquid instruments. Like cash, about maybe 10% maximum. They've really took the whole hook, line, and sinker from the financialization of the world to put everything into things like equities and housing and real estate, and those things are not liquid, P.S. In the area where I live, north of Toronto, all hell is breaking loose right now. People are trying to sell these subdivision-style homes that we're selling for $2 and $3 million, but 2 years ago haven't gone up 55% in 2 years. So it is an absolute disaster for the household and for businesses who took out a bunch of debt at all-time lows, 5,000-year lows. So this is what's going on in the world, and it's relative. It's not about one country having this big strategic playbook and, doing it so much better than the rest.
Okay, I want to stay with rates and come to you, Adam, in 1 minute, but just a thread I want to pull on the Canadian housing market, because this is a Canadian conference, and you mentioned 55% of income is now going to funding shelter. Recently in your letter, I also believe you called that mortgage interest is up 30% year over year for Canadians, and inside of the next 2 years, 45% of mortgages in Canada are up for renewal, obviously at significantly higher rates than when they were wrote down. This is correct?
This is correct, and the average house price here is still a redonkulous $800,000 or so, $750,000. In the big centers where most of the population lives, like Toronto and Vancouver, the average home price is more like $1 million. Get out a mortgage calculator, please. I do this all the time. Put in the numbers. I couldn't qualify to buy my own house at current rates if I was looking to purchase it right now. The amount of people that can pay the dollars being asked for these assets is just so tiny relative to the bulk of the supply. So this is why I say liquidation event. We talked about it on the stage last year. It's been in the works. It's slow. Real estate cycles take 4 to 6 years or so to bottom. Everybody loses interest and goes, oh, they hiked rates, we're fine. No, we're not fine. It's a lag, and it's coming, and it's evident everywhere you look right now. So I think that's going to continue to be a major theme driving disparity between people and incomes and the economies.
Adam, we were chatting about this lag before we got on stage. So maybe elaborate on what you're focused on and what the public might be misunderstanding in terms of economic response to interest rate changes and the lag that occurs.
Yeah, I'm so glad that Danielle brought this up, because this is exactly my big concern for this year, which is, if you read the headlines, if you listen to, monetary authorities, the administrations, everybody says, look, everything's great, right? Soft landing, no landing. I think people are really beginning to buy that hook, line, and sinker. We saw the stock market take off at the end of last year. People are entering 2024 with a lot of enthusiasm. And they're really acting as if the lag effect is not going to happen this time. I mean, we got to remember that we hiked interest rates more aggressively over the past 2 years than we've ever done in terms of rates and so many rates and heights in such short a period of time. We've also been conducting QT in the middle of that. And I think a big mystery has been, well, then why didn't the recession that everybody expected at the beginning of 2023 materialize, right? I know Danielle has got thoughts on that, and we'll get there. But I think a huge part of that was positive net liquidity that was flowing into the system from a lot of different sources, and it just pushed the timeline out. But it's happened for so long that I think a lot of people have begun to say, oh, it hasn't shown up yet, it's not going to show up yet, right? And so I think that's the big question you got to ask yourself as an investor, and even just as a consumer going into this year, which is the lag effect not going to matter? Is it truly different this time? Or is it going to arrive, and when it does, how pissed is it going to be? And I actually tell Americans to look at the Canadian market, because as you're talking about with housing, you guys are like a preview of coming attractions for us, right? Because you guys have different mortgage duration structure here. You guys have, I think as you said, 45% of all mortgages here are going to re-rate in the next 2 years?
In Canada.
Yeah, in Canada, yeah. So we get a different structure in the US. It's going to happen there a little bit more slowly. But if rates don't come down in time, what's happening to you guys is going to happen to us. And I do wonder, let's say that Powell is able to deliver the 3 rate cuts that he says the Fed wants to do next year. And the discount rate goes down from what, 5.5-ish to, let's say, 4.5-ish, right? It's still really high relative to what the cost of debt has been for the previous decade, right? And we've got this maturity wall of corporations that's really beginning to arrive now. And we're going to have almost $1 trillion of corporate debt re-rate in 2024. Same thing with consumer households, and we're already seeing the fact that they are taking on debt like crazy right now. We're at record debt levels. A lot of that revolving credit debt is now at record high interest rates. And so, we basically have this date with destiny of, we're going to get to a point of debt saturation where corporations start re-rating and they've got to start cutting costs. consumers can't keep spending the way they've been, they're really going to start contracting consumer spending. And if corporations react to that by then laying people off, there's a potential for a real downward vicious cycle in consumer spending. U.S. economy is 2/3 consumer spending. That unlocks a lot of pain for us that I think the market is just hugely discounting right now.
So it's logical, and if we had this conversation a year ago and been able to predict what rates we're going to do over the next couple quarters, we would have thought the economy would have been hit by a wrecking ball.
Right.
And all the forecasters predicted this, but it didn't really materialize yet or ever. So Danielle, forecast for 2024, economic forecast, is the wrecking ball coming? Money's more expensive, that makes things harder, right? Or what's your take? Forecast 2024.
So, the U.S. consumer is not going to go down without a fight. In the month of December, American consumers put $55.8 billion on their credit card in a month. $19 billion in buy now, pay later in a month. We've never seen credit growing this fast. The U.S. consumer is refusing to stop spending, and we forget that buy now, pay later is fairly young, but it's not incorporated into credit rating agencies. So they don't see people buying now and paying later. It does not show up.
Buy now, pay later default rates are already spiking, by the way.
It's incredible. But again, there's two sides to every story. And the other side is the regional bank earnings were a bloodbath of charge-offs related to credit cards. So just because you want to take on as much debt as you possibly can, the more these lenders have, Discover Financial is a train wreck, but the more they have to deal with these charge-offs, the tighter lending standards are going to be if Jay Powell holds his ground. The University of Michigan expectations went up in January precisely because we graphed it out for tomorrow's feather, precisely because American households are like, this is awesome, credit conditions are going to loosen up. No, they're not, because the lenders are losing so much money that they're going to make it harder and harder to access that credit. It's demand and supply of credit to U.S. households. And by the way, most post-war recessions that we've gone into with 2 quarters of rising consumption when we're already in recession. That's how hard business investment gets slammed. And every single Tom, Dick, and Harry CEO right now is in a race to do deeper and deeper layoffs. I mean, every one of them are like 25% of our workforce. Big cuts.
Anybody on the panel want to offer a rate prediction for 2024? What do you expect Powell will try to do or be able to do?
I will just say that I don't think they're going to get anywhere near the 5 cuts or 6 cuts that the market has priced in unless he is forced to do so by a market crash. So if there's a credit event, then yes, but I don't think on his own, based on the way things are now, he will cut 5 times or 6 times.
I think that, what I find amazing is people talk about the 25 beeps. I've been around for about 25 years in this business, and they cut by 1 point or 100 basis points if they panic. So we could just have 1 cut of 1%, and I wouldn't be surprised, because they cut in reaction. They're not, they don't do it in advance. They do it in reaction to shit going bad, right? So I think that is likely to be the scenario, and the cuts will come a lot quicker than people anticipate when they start, is what I think.
So just a question for my fellow panelists here, which is, Powell is positioning his now more dovish rate cut outlook as being proactive, right? Which is, hey, we think we've done what we need to do. We don't want to wait until it gets to 2% to start cutting rates because momentum would bring us below 2, so now's the time to start cutting. Do you believe that, or do you believe he's cutting because there's something that's scaring him? That he is reacting to something that he's just not telling us about?
Well, we have to remember the reserve repo facility is emptying out pretty quickly. So the financial system shock absorber is coming down very, very fast. So if it's the end of May, as many predict, that there's no more cushion in the reserve repo facility, all of a sudden you're a lot more aware of quantitative tightening, whereas it's been easy enough to forget that there's this other form of tightening. By the way, $75 billion expected shrinkage in the month of January. Adam and I were talking about this a few weeks ago. That lag effect, starting in January of 2024, that's new. That's going to be felt in 18 months. The current lag effect of quantitative tightening. People are thinking, okay, so it started in June of 2022, so the lag effect should just be over. No, lag is dynamic. I'm sounding like a former central banker, which I am. But the lag effect itself is dynamic and it keeps on moving. And it's why when the Fed starts to cut rates, if it's going to be 25 basis points, it's your proverbial pushing on a string. They don't accomplish anything because they're fighting with their own effect of prior tightening filtering through the economy.
Okay, now Brent, your comment on, you can't imagine 5 or 6 rate cuts are possible until, and then everybody said there's a credit event, right? So my question for you is, where is the vulnerability? What could trigger that event? Is it domestic? I mean, before we got on this panel, you were saying the mistake a lot of investors make is being a bit too myopic in their view of just looking at the US and the US Fed, and there's a lot more going on. So what are you watching, and what strikes you as that potential fracture line? Where's the vulnerability right now?
Yeah, I think that's a good thing to consider. I mean, it's important that everybody focuses. I mean, I understand why everybody focuses on the U.S. It is the biggest market in the world. It's arguably the most important. But I am just as worried about a potential trigger outside the United States as I am inside the United States. Because remember, the whole world, again, we go back to the dollars, the whole world uses dollars. So if there's a credit event outside the United States, and the euro dollars start to disappear, then they start drawing on the dollars from the US market that gets sucked out of the US, and that causes a credit event in the US. But where I continue to worry about China. I mean, anybody that looks at, and I know there's this popular theme that China is outplaying the United States, they're smarter, they're strategic, but if their stock market is down dramatically. I don't even know the percentage. It's like down 50, 60, 70%. Their currency is down 5 or 10%.
Their real estate market.
Their real estate market. So here's the point. If the U.S. market were to fall significantly, and the U.S. dollar were to fall significantly, and the U.S. housing market were to fall significantly, everybody would say, see, it's the end of the empire. That is exactly what's happening in China right now, yet people still say China is outplaying the United States. And so I continue to think that it's possible because of the deflationary pressure due to the real estate market in China, that China may have to might have to defend that, or they might have to react to that deflationary pressure by devaluing the yuan, which would send a huge deflationary wave to the rest of the world. And so that I worry more about that than I do about the U.S.
So I have a question for Danielle, which makes it sound like I'm talking in the third person, which is kind of, anyways. So BCY function on Bloomberg, I pull it up daily just to follow it. Have you noticed, it's even in Canada, have you noticed that there are bankruptcy waves, corporate bankruptcy waves everywhere?
Yes, absolutely. It's up 30% in the U.S., but I think in Canada it's basically that the trustees in bankruptcy, I know a few and keep in touch with them in Canada, they are booming. They are seeing volumes up 30%. They're doing a lot of consumer proposals, restructuring, because the math just doesn't work. That's the reality. So, the good news is we have bankruptcy laws. We can get this thing rebooted. Writing down debt, tale as old as time. That's how you get out of this, partly. But that means that the asset prices tied to it are coming down as well, which is, of course, a big problem for the economy.
It's been fascinating to watch the same exact phenomena play out in Germany. I mean, Germany's pushing through major job cuts. This is an industrial juggernaut that's stumbling, the third largest economy in the world, and nobody's really paying attention.
Now, down the line very quickly, closing word, 2024, where are you putting cash right now? Talk to me about your portfolio. You can pick one asset if you want to keep it simple, but highlights of your portfolio for 2024, where are you putting cash? Danielle, I'll start with you.
So our bond portfolio is 100% in the highest quality credits, governments, municipalities. We have an average duration of 4 years, so we're not out real long because we're not trying to scare the pants off people. The volatility has been extraordinary in the bond market the last 2 years, but having had the highest qualities and the shorter duration, it's been relatively smoothed out. In addition, we have about 20% of our portfolios in U.S. Treasuries, short U.S. money, and we have 20% just in pure old cash because, there's that saying that the stock market is this tool that takes money off the impatient and gives it to the patient. And that's what you need cash for. So,
I love that. Thank you. Adam.
I'm going to sound pretty similar. I think that right now you get paid to wait, see how this stuff shakes out. So I think sitting in short-term treasuries is pretty smart for an investor who's not feeling incredibly comfortable about or confident about where things are going. I do think that the year is going to be more volatile than we've been used to. So I think volatility actually is a good way to play it. For a whole bunch of reasons we didn't really get a chance to get into here, but somewhat to the previous panel, I think holding a position in gold makes sense. I'm definitely doing that. And I do think, not entirely sure how long rates are going to remain as high as they are. Maybe we'll get Powell's 3 rate cuts. Maybe we get a whole bunch, in some sort of crisis. So I think taking some capital and going out a little bit on duration. I'm not saying play the massive end of the curve like some folks who are more willing to speculate than I are, but 2-5 years or whatever, if you end up getting 4 or 5% return for the next 5 years in part of your portfolio, it's not too bad. It's ballast.
No doubt. Brent.
Yeah, so I would say that, this is my 25th year of doing this, and I would say that in the 25 years I've been doing this, I've never been more uncertain than I am right now. And that means that I'm not certain that we're going to have a crash. I'm not certain that we're going to have a recession. I think it's very possible. I think it's likely we get some kind of a recessionary shock. It depends on how the central banks would react to that, but I think it's a very good time to have a very boring portfolio. But that doesn't mean you sell everything and sit in cash. If you own equities, I would hold the equities. Maybe you hedge them a little bit, but I would definitely have some T-bills on the sideline, so that not only so that you have some dry powder if we get a crisis, but that if you have some dry powder, you won't be as stressed if we get the crisis. And if you're not as stressed, you will make better decisions. So, yeah.
Very good advice.
Yeah.
Danielle.
So I think that credit is really rich. And when you say credit's really rich, I mean that credit spreads are very, very, very low. And so one of the things that we're recommending to our clients is finding a way to play the other side of that. So we're looking at high yield exchange traded ETFs, but on the short side, because it's very difficult for individuals to play this market. And they can't just go out and buy high yield CDX because the insurance premium is going to go up. It's just not practicable for smaller investors. I think India is going to start to sort through a lot of their issues. So I think India is something that you can put in your portfolio and just close your eyes. And I think Mexico's got a great opportunity again this year because they have a genuine lunatic running the country, but that ends in June, and there's tremendous opportunity to forge tighter supply chains with the United States, and I think that the U.S. companies want the alternative.
100%, yeah. And India has some of the best demographics in the world, which is often one of the leading indicators.
That's your next commodity super cycle. It's when the politics in India works its way out, because it ain't coming from China.
Got it. Okay. Look, I want to thank you all for joining me up on the stage today. Every one of these panelists will be found on a workshop stage again at this conference. So if you want to hear more, go check that out. Can you please give them a loud round of applause?